In my house, we do what we call a keep it or chuck it. You know, when you're trying to stuff another sweater in your drawer and it's no longer closing. Well, that's when you know it's time. By implementing the keep it or chuck it strategy, we're less bogged down by the things that no longer bring us joy. Maybe they've lost their value or we just don't want them anymore. And the same is true for our portfolio holdings. So today, I'm bringing you guys on a ride along, and I'll share with you all of my holdings and which positions I'm thinking about exiting. And I'm hoping you'll weigh in down in the comments because you guys are super smart and I appreciate your collective investing wisdom. So we're starting here in my portfolio dashboard. Current value is just under $87,000, and my projected annual dividend income from these holdings is inching closer to my goal of $4,444, currently sitting at $4,226.36. To the right, you can see all of my holdings and how much dividend income that they produce each year. Right now, I've got a total of 37 holdings, one covered call ETF, which is JEPI, and my largest holding is SCHD, the Schwab US Dividend Equity ETF, which makes up 27% of my total portfolio. And it also produces the most annual dividend income for me at approximately $850 each year. The plan is going to be to continue to grow this position in the next year. I'll be using SCHD as my target for Prosperity 52, which if you haven't heard about, I'll link in the comments below in case you want to join me. But we're not here to talk about SCHD. We're here to talk about whether or not I need to sell out of some of my positions. So in order to do that, we need to talk about creating guardrails for our portfolios. Bumpers on the bowling alley, if you will, to make sure that our balls are rolling in the right direction. So, how do you decide if a company has the chops to be part of your portfolio and remain firmly seated in the keep it pile? Well, for me, that first step comes with determining what's important as an investor. So we're going to run down 11 quick metrics that I look at that will help me to create my strategy and strip the emotion out of investing that will then lead me to figure out whether or not I'm going to keep it or chuck it. These are not listed in order of importance, but we're going to start with dividend streak because I think it is an important one. And basically, this just measures the number of consecutive years a company has increased its dividend. And because as dividend investors, this is important to us, we want to see companies that are consistent and have shown a commitment to rewarding their shareholders with higher dividends year over year. The second thing is payout ratio. And this is the percentage of earnings a company pays out to shareholders in the form of dividends. If the percentage gets too high, they won't be able to continue paying you a dividend. Now I'm over here on Seeking Alpha just so that I could better depict the importance of payout ratio. And we are on VFC Corporation. And basically, payout ratio is the percentage of the earnings a company is going to pay to its shareholders in the form of dividends. If the percentage gets too high, see VFC Corporation with a 822.53% cash dividend payout ratio, they tend to cut their dividend, which is exactly what they did this year. They cut it by 41.2%. So this is a great example of why we need to be watching this. The next thing we're going to talk about is dividend growth rate, which is a measure of the rate at which the company's dividends have been increased over a specific period of time. So because Deere is fresh in my mind because it's part of my SCAD group of sexy industrials, they alone have in the last year increased their dividend by 15.83%. Personally, I like to see a 5-year dividend growth rate over 10%, so this one kind of checks the boxes for me. And so while we're talking about Deere and Company, we might as well use this as another example to talk about total return, which is basically the appreciation of the investment's value. Think capital gains, share price appreciation, and any income that's generated from it. So dividends. So if we stick with the big green tractors, you can see that the total return is 425.39% in the last 10 years, which I kind of like, you guys. It's definitely squashing the S&P 500. Another important metric is revenue growth. Sticking with Deere, you can see that they have consistently grown their revenue over time. Number 6 is free cash flow, and this represents the cash generated by a company after accounting for expenses and investments in their capital assets. It's basically the money that the company is going to use to pay us our dividends if they want to expand their company or potentially they're looking to reduce their debt. So I popped on over to the Dividend Tracker because it has a nice little graph for free cash flow. And you can see in the last year, they've definitely increased their free cash flow up to $4 billion. Let's talk about dividend yield for a minute. This is based on the dividend rate that's established by the board of directors. So the yield's going to fluctuate with the share price. Share price goes up, yield goes down, and vice versa. How high of a yield are you looking for in order to include a company in your portfolio? Number 8 on our list is PE ratio, or the price to earnings ratio. This basically compares a company's current share price to its earnings per share, and it helps investors to understand how much they're paying for each dollar of earnings. So, for example, if a company's stock is selling for $20 per share and it earned $2 per share over the last year, the PE would be 10. This means that investors are willing to pay $10 for every $1 of the company's earnings. Number 9 on our list is beta, which measures the volatility of a stock compared to the overall market. So a beta greater than 1 suggests higher volatility, while a beta less than 1 indicates lower volatility compared to the market. So this is where you decide how much risk you're willing to take with your investments. So if we take John Deere, and I'm over here on FinViz, they have a beta of 1.03. If we compare that to a company like Tesla, you'll see that the beta is significantly higher at 2.26, indicating more risk. Number 10 is current ratio, and this compares a company's current assets, like their cash and any inventory that they have, to their current liabilities, like bills and short term loans. It shows the company's ability to cover its short term debts with its short term assets. So, for example, if a company has $500 in assets and $250 in current liabilities, their current ratio is 2, which means the company has twice as many current assets as current liabilities, suggesting that the company might be in a good position to comfortably pay off its short term debts using its short term assets. The next thing I look at is debt to equity, and this is a financial metric that compares the company's total debt to its total shareholder equity. So if you have a high debt to equity ratio, it means that the company is using a lot of borrowed money compared to its own. It might help a company grow faster, but too much borrowing makes it riskier. Whereas a low debt to equity ratio shows that the company relies more on its own money rather than borrowing, and it's safer because they're not heavily in debt. That was a really long list, you guys. I'm sorry. If you're still with me, thank you. But I felt like it was important to review the metrics because we aren't just talking about an old sweater with a hole in it. We're talking about our investments. So it's important to understand all the metrics so we can adequately make the decision whether or not to keep it or chuck it. So how does this apply to all my holdings? Well, I needed a visual to look at all the metrics listed so I could review everything at once and see what popped out that might need to land in that chuck it pile. So left to right, looking at this spreadsheet, you'll see the company ticker, the current share price, the dividend rate. Oh, and I have definitions, you guys, in case you're having a moment, you might forget something. The dividend yield, the PE, payout ratio, the beta, debt to equity, current ratio, the 5-year dividend growth rate, the total return, and finally the Chowder score, which if you have no idea what I'm talking about, I'll link to that video so you guys can take a peek at the dividend triangle and Chowder. I kind of like the ease of the Chowder score. This spreadsheet is just a means for me to look at all of the data for all of my current holdings so I can kind of scroll through and see where we're at. So let me show you what is kind of popping out at me. So the first thing I want to talk about is Home Depot. The debt to equity is 34.44. Now remember, this means that they're borrowing a lot of money to keep things going, which they're going to need to pay back with interest. I presently own 11 shares with about $3,500 of equity tied up here. Does it make sense to bag it or chuck it and reallocate the money elsewhere? And you can see here that the long-term debt has continued to grow. So the debt makes me a little nervous. Other than that, we've got a 5-year dividend growth rate that's 15.4. The total return is 394, beating the S&P, and the Chowder score is 18. So those are all pretty good numbers. What do you guys think about Home Depot? Next, I want to talk about Lowe's, and you'll see here that debt to equity is actually not pulling over from FinViz, which is strange, but upon looking at it, I realized why. It's actually a negative number, which is the same case for Mo, or Altria Group, which we'll get to in just a second. And you can see here that Lowe's long-term debt has continued to grow, and in the last year alone, it went up by 37.79%. I own 14 shares and have $2,900 tied up there, so I've got some decisions to make. The next one I want to talk about is Altria Group, and the ticker symbol is MO. Payout ratio is currently sitting at 115.44%. 5-year dividend growth rate is only 5.85%, and they're not touching the S&P 500 for total return in the last 10 years. They do, however, have a pretty strong Chowder score, but that's really based more on the yield than on the growth rate. So in total, these 3 holdings make up $13,000 in my portfolio. So I've got some decisions to make, but I would love to hear your thoughts. What would you do? Please leave me a comment below and then go and take a peek at this video next.